what we've seen in the last, I would say, really 3 years is an economy that looks fairly robust at the, at the aggregate level. You can talk about that at the consumer level or just in terms of GDP. But then when you look at earnings growth for the last several years, it's been pretty lousy for most companies until recently. Recently, we've seen a pickup. More companies are starting to grow again. And I attribute this to essentially the government being, crowding out, if you will, much of the economy. That is the reason we have inflation. For the main reason we have inflation, too much government spending. Also, it has kept interest rates higher than they would be normally. So real interest rates at 2% is actually quite high, Tom, as you know, for the last 15 years. And we're such a financialized economy that, that has had a sort of a braking effect on, businesses that don't have easy access to capital. So I think the Fed right now is sort of in a, a tighter place than they probably want to be. They would like to cut rates, but they can't because inflation now is picking its head up again. So they're on hold. They're not going to raise rates in our view, but we're trying to find that equilibrium now. Like, how big should the government be? How can we liberate the private economy in a way where we have better velocity, kind of in the real private economy than just government?
Mike, I'm looking also at your chart book where you guys track what companies are actually saying on their conference calls. What's top of mind for corporate America? And I guess not surprisingly, one of those key issues is tariffs. How did tariffs kind of factor into kind of your view of inflation and maybe how the Fed will proceed and how that might impact stocks?
Yeah, well, I think the Fed has told you, pretty straightforward since December that the uncertainty around tariffs is another reason why they're probably going to take a pause on the rate cutting campaign. Now, remember, they have another lever they can use, which I think they will, which is to basically end QT finally, which is, a decent amount of repurchases then across the curve. They can probably start doing that in May or June. And that's another lever that they can sort of pull on. As far as companies go, I mean, companies are always, trying to incorporate these changes into their business models and how they're running their own companies. And tariffs are front and center right now because not only is that a potential headwind, but it's also uncertainty because, one day we have them on, the next day they're being delayed. And look, that's what companies have to manage that process. The good news is, I think in the last round of tariffs back in 2018, a lot of companies did relocate some manufacturing, some final assembly to areas like Mexico. I think that may be one of the reasons why the president is going after Mexico, because that was kind of a backdoor way of avoiding tariffs on China. So it's just going to be, 6 months of uncertainty. And that's why companies are mentioning it because, they don't want to get caught, in a way where they're guiding too high and then tariffs end up being a headwind for their growth expectations.
We're going to hear from Nvidia Wednesday after the close. That's one of the last big companies reporting earnings in this cycle here. What did you take away from this quarterly's earnings cycle and, more importantly, maybe the guidance you've been paying attention to?
Well, first of all, it shows that the fourth quarter was boom times. Now, some of that, once again, was government. Fiscal deficit was up 40% year over year. But also there was some excitement around, just a clean election, maybe a more pro-growth, administration. And so there was more activity in the fourth quarter. And so what we're seeing now is kind of just that rolling off a bit, that maybe we got a little ahead of ourselves. Higher rates and stronger dollar was weighing on some of the guidance for 25. Companies tend to do that seasonally anyways. They want to lower the bar a bit at the beginning of the year. But then the other things that have been we've been focused on, really in no particular order: tariffs, as you already mentioned. Number two, we have immigration enforcement, which has been a huge fiscal boost and also a labor supply boost. And then we have DOGE, right? The Department of Government Efficiency. Right. They're off to an aggressive start. I'm optimistic I'm probably more optimistic than most that they can make some headway there. But remember, the more successful they are in the short term, the more growth negative that is in the near term before you get to the good stuff. And then, of course, the positive effects of policy like deregulation, maybe extending the tax cuts, those come later in the year. Those require congressional approval. And so that's just not, that's going to take 6 to 12 months. And so the bad stuff first, the good stuff comes later.
Mike Wilson, to get back to your idea that alpha is the way this works, and let's just generalize that as individual stock selection, what is the Mike Wilson process there? Is it securities research, Graham, Dodd, and Cottle, bottom up? Is it a sell-side concept of looking at what's going to win? Or is it more factor-based where you're looking at different items and trying to figure out, like say, will momentum or something else win?
That's a great question, Tom, and it has changed over time. I think the main thing that's changed in the institutional world, anyways, is the time horizon. So, 20 years ago, I would say institutional investors were kind of in this 6 to 12 month time horizon. It's now, 1 to 3 months, and in some cases, 1 to 3 days. So that's what's changed, and that means you just got to be really laser focused on kind of news at the margin, whether it's fundamental news around a specific company, whether it's a macro changing event that can affect certain companies differently. So all those things we look at, I would say that quantitative analysis and factor analysis has probably picked up the most. Most institutional investors now, including ourselves as advising them, use that tool, and it's quite helpful. As you mentioned, price momentum is probably the most important factor variable because everybody likes to perform. And I would say, that can also get you in trouble because what ends up happening is you end up, as I like to say, using price as your analyst as opposed to doing the analysis and then letting price follow. And I think that's just the world we live in now. Everybody's short-termism. I don't think that's going to change anytime soon.